Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, May 17th, and then we'll see how things look for Thursday, May 18th. We had a pretty solid update. Unfortunately, we're just coming more to the top of this trading range that we've been in. We haven't really broken out yet with price in the S&P 500, but we have seen some improvement. On a short-term basis, we're looking more positive. We're still pretty much mixed in the intermediate term, and there's some concerns that we need to focus on. And I'm starting to wonder, are we going to go up to this resistance level that we've been hitting? Even though we broke out above some lower resistance, there's some upper resistance where we're at. Are we going to hit that level and then turn and start to come back down? The NASDAQ and the NASDAQ 100 have really been leading the way higher. Are they looking a little exhausted right now? Now, before we get going, I do have a supplemental video that I posted a little over a week ago. The charts haven't changed all that much, so it's still very relevant. I do have a PDF of all the slides and charts, whether you're watching the video on YouTube or Rumble, or if you're watching the podcast. I do have a private Facebook group that you're more than welcome to join. There's no poll posted for this week. So let's go back and talk about what happened. We did have a higher open, and prices went above R1 at 41.27. But then we fell below the daily pivot at 41.18. Then we rebounded back above R1. Then later in the day, we started to get some strength into the market. Prices climbed above R2 at 41.44 and above 41.60 before chopping sideways and then closing above 41.50. We closed at about 41.58. We never did reach R3. That was up in the 460 to 470 range, and we never got quite that high. We were up 1.19%, and this is interesting, we had volume that was above average. Now that's just one day. The trend has been below average, but to see an upward move on an increase in volume is kind of encouraging. There may have been some short covering coming into the market as we started to go higher, since those folks have to buy to get out of their positions. The technicals are more positive in the short term, but we're range bound right now. Inflation and interest rates are really the big concern. They're citing some hope in the debt ceiling situation. That's what really gave the market a little bit of a push higher, and we still are waiting to see if we're going to get any more banking information. What are some comments that we can make? The S&P is back above the 4150 level. And if we do start to fall, the 4100 level has been acting as pretty significant support. There's no deal concerning the debt ceiling right now, but there is hope. There's some optimism that that will get worked out. Value did outperform growth. That's a little bit of a concern. In a good solid up move, we want to see growth outperforming value. The consumer discretionary sector was up 2%. It's been lagging a little bit lately, so to see it going up was pretty encouraging. And on a short-term basis, we have the CCI 20 and the Williams percent are extreme positive right now. Not very extreme, and I have charts to show you. This could be that maybe momentum is shifting more to the positive side. The dollar was up and interest rates were also up, which both of these would have usually provided some headwinds for stocks, but they didn't do that on Wednesday. The 10 to the 2 and the 10 to the 3-month yield curves, they still remain inverted. Sentiment is positive. With the update, we ticked back up. We had been neutral. We closed at 61 where we had been at 55. Our trend is now positive. We've crossed above the moving average. Now we're still well below 20, so we're not really in a strong trend yet. The green line is on top and it went up slightly, but we're still in a sideways pattern overall. Our bias is now positive with the update, and I've kept our momentum at mixed because we've had one up day, one down day. We've been shooting all over the place. The economic reports that came out, we had the MBA Mortgage Applications Index for the week. It was down 5.7%. Purchase applications were down 4.8%, and refinancing applications were down 8%. Total housing starts came out. They were up 2.2% on a month-over-month basis, and if you project this out annually, it's 1.401 million, a little bit less than the 1.405 million they had expected, but it's up from last time where we had a reading of 1.371 million. Single-family starts were up 1.6% month-over-month. Building permits were down 1.5% month-over-month. They came in at 1.416 million. They expected more than that at 1.438 million. Last time it came in at 1.437 million. And single unit permits were up 3.1% month over month, but if you take this on an annual basis, we're down 21.2%. Looking at some Isabel Net charts on their blog, what are most people focused on right now? And we can see as things start to go up, the crowd starts to move over into a particular area. Right now, being long in tech stocks seems to be the place to be. Being short in bank stocks come in second place. And then the other different positions that you can see here. Real Investment Advice came out with their yield curve inversion chart, just showing that a recession is imminent when there are 50% of the yield curves that are inverted. We're all the way up to almost 100% of their yield curves currently. Looking at some earnings information, the S&P earnings yield gap versus the real, meaning that takes inflation into account, 10-year U.S. Treasury yield. When this is dropping, that means stocks are getting pretty expensive. When this goes back up, that means stocks are less expensive. Then the inflation causes recessions chart, where we're looking at the banks that have been really going down relative to the S&P 500 as the U.S. 5-year yield has been going up. You would think this would be pretty good for banks, but that's not really helping them right now. A lot of this has to do with the fact that they took all that cash that they had during the COVID lockdowns and bought longer-term bonds, which now interest rates are going up, and they're stuck with these other assets that are giving a lot lower return. Then growth expectations are the weakest since going back to last December. Folks had been getting a little bit more optimistic about things, but now it's starting to drop off again. And then this chart is suggesting that some folks are starting to get overweight in bonds. The last time they were really overweight in bonds, this was right as the financial crisis was happening. Then systematic credit event, that's banks going under. It overtakes inflation staying high as the biggest tail risk. I might say this is a headwind risk. Looking at Real Investment Advice on their daily blog, they had an interesting chart of U.S. retail sales on a year-over-year basis. That's nominal, meaning not taking inflation into account. It's really been declining overall. And then down here, where their real retail sales, meaning they're adjusted for inflation, they are also declining as well. Economic reports that came out, we had housing starts and building permits that came out. Here's a chart with the 3-month moving average. The blue line are housing starts, and they ticked back up slightly, and building permits also ticked back up. Both of these can often be leading indicators of the economy. Now, just because we turned up doesn't necessarily mean everything's shifting, and there's been other times when we turned up only to keep going back down, but this is showing some improvement. Now, getting into our charts, where we opened up higher, we opened up at R1, went above that a little bit, came back down below the daily pivot. Then we were able to get back above the daily pivot, get above R1. Then this is when the market really started to take off. We made it all the way up to R2. We didn't get up to R3, so I didn't put that on the chart. After we hit this 4164 level, we started to chop around sideways, but we were able to hold on to most of those gains going into the close. Here's the intraday chart where we had seen stronger action in the SPY in the pre-market session. Then it went up with the rest of the market, and currently we're drifting more or less sideways. Growth still continues to outperform value, but it underperformed in Wednesday's session. This ratio was going down overall, showing that growth was underperforming. And we can also see that growth was up, but value was up more with the large caps, the mid caps, and even the small caps. Looking at sentiment, fear is pretty much going sideways right now. There's a lot of complacency in the market. The VIX ticked down with the update, both on the line chart and on the bar chart. The VIX of the VIX is also showing a decrease. I was expecting this to go up a little bit because we're getting closer to options expiration Friday, but so far that has not happened. And then here's a chart showing the MOVE index. We're pretty much in the midpoint. We were coming down. Bonds were down in Wednesday's session. The VIX is also getting very complacent. And then here we have the green line, which is the spread between the MOVE index and the VIX. and the red line is the S&P, just to get an idea of their overall movement. And then on the very bottom, you see where the correlation is still very strong between the two. The skew index, pretty much at the midpoint now, not getting extreme to the upside or downside currently. In our fear gauge that we look at, ticked down just slightly, but fear has been increasing on this chart, where fear is pretty much going sideways on this other fear gauge that we look at. Folks are still favoring a risk-off posture, but we're seeing some improvement here, but not enough to really change the overall environment. Looking at our advanced decline line studies, we had a good up day based on price, but we're not breaking out yet. We're still seeing a negative divergence here in the short term because the advancing volume is still below its moving average. Longer term, we're also working off of this negative divergence. We did see an improvement with the new highs, but not enough to turn the 5-period or the 10-period moving average back up. And we're just about at the midpoint with our advanced decline ratio lines. Accumulation distribution still remains positive overall. And then looking at our advanced decline line studies on the NYSE, we're showing some improvement with the cumulative AD line, but it's still showing an overall negative divergence. We saw a little bit of improvement with the regular advanced decline line. Common stock, we're still noticing this longer-term negative divergence. And the advanced decline line extended this trend line. We came right down to this level. Will we get a bounce up off of that? Looking at our broader range, NYSE, we're still underneath the declining moving average where the S&P is turned back up. The mid caps are back up to their moving average, and the small caps are showing some improvement, but are still under their moving average. Looking at our trend, this is where we're seeing a little bit of change. The ADX is trying to turn back up and has crossed above its moving average. The green line's on top, and it did advance. However, the ADX and the moving average remain below 20, so that's still a trendless environment overall, but we default to the positive. Volume did pick up enough, but not really to change our longer-term measurements that we look at. In the short term, we're still getting more to the top of this range. If we end up going down from here, you could suggest maybe this is a short-term head and shoulders top where we have a left shoulder, the head, and then the right shoulder. Don't know if that's what's going to happen. I just saw that here. But we have not really broken out yet as far as price is concerned. If we do, we'll need to break above previous highs and also break above resistance that is still above current price. On the bottom, we see where we were just slightly above average with our volume. The CCI 20 period is just barely looking extreme right now, and the Williams percent are just barely extreme positive. This could suggest good momentum. We're above both of the 20 period moving averages, and our stochastics have turned back up in the short term, almost getting to an extreme reading, turning back up in the intermediate term, showing some improvement, but still negative in the long term. The force index advanced to be further above zero. Then switching to some intermediate term charts, we're still below the dashed line with the balance of power, and we actually ticked down slightly. We're above both the double and triple exponential moving averages. And the go-no-go system is still pretty much chopping sideways, but positive with the darker colored blue bars. The TTM squeeze is showing some improvement, but is still negative. The PPO is still positive in the long and intermediate term. Short term, we've crossed back above zero. The S&P 500 McClellan oscillator showing some improvement, but we're still below zero, still working off of this negative divergence. And then the broader range NYSE McClellan oscillator showing some improvement, but still below zero, also a negative divergence. The Swinland trading oscillator based on price turned back up, but we're still below zero, and we're also still below zero based on volume. The PMO remains negative, both based on price and volume. Our PMO study still shows this negative divergence, saw some improvement with the percent of PMOs that are rising, pretty much sideways with the buy signals, and still declining with the PMOs that are above zero. The S&P 500 for the Elder Impulse system has switched back to positive. This is another big one, potential big signal that we're seeing here. The parabolic SAR now has a dot on the bottom. That has switched over to positive. Then looking at some of our oscillators, the slope is trying to turn back over positive, and here are all of our oscillators with the slope on top. All of the other oscillators are flat to negative. We're above all the plotted moving averages in our moving average tree. The BPI remains above 50, so that's positive in the short term, but we still have this negative divergence in the longer term. And the NYSE BPI is still below 50 and going sideways. The Chaikin money flow declined just a little bit on an up day. That's a little bit of a concern. And the Chaikin oscillator did turn back up slightly, and it's positive since it's above the zero line. The money flow is just a little bit below 50. And the ultimate oscillator ticked back up slightly. That is positive. The vortex has the green line on top. That's positive. The summation index based on price is starting to flatten out, and we're turning up a little bit based on volume. Now, sometimes with this chart, we see volume turn up before price. We also get some false signals sometimes. That's because the top part of this chart and the bottom part of this chart are calculated in different ways. On balance volume is still negative overall, even though it showed some improvement. And then looking at those stocks above their 250 period moving averages, we're not really breaking out yet, and we're still showing a negative divergence with both charts. The Copic curve, we're getting ready to cross above. Now, this is a little bit of a concern. When we get good, solid Copic curve signals are when we get really down far. We're possibly generating a positive signal right at the zero line, showing that we haven't really washed out as far as the market is concerned. That's the negative look at this. On the positive side, one thing I've been mentioning is maybe the market is putting in a bottom by consolidating sideways. That is what we're seeing also in this Copic curve signal if it continues to go back up. Looking at our Fibonacci and line studies, we're still below this 4170 level. We have not reached that yet. Longer term, we did get back above the 100% retracement level. We closed at 4158, and this is at 4123. So we have been able to recapture all of these levels now. Longer term, we're coming right back up to this 50% retracement. We closed at 4158. This level was at 4156. That is more positive longer term. Also, longer term, we still have quite a ways to go to get to this 4214 level. And if we start to fall, we'll be watching the 4020 level. Also, we're coming up to this downward sloping trend line here, but we haven't hit it yet. That's at about the 4200 level, which may act as resistance. We have been able to break out slightly with our 20-period simple moving average of the open, high, low, and close. We're coming now to the end of this 50-day cycle. That will be Friday, May 19th. Will that produce some kind of a change in the market? We're also watching this blue line here at the 4080 level as potential support. Our different charts, the Heikin Ashi is turning back a little more positive with an open candle. The Kegi has switched back positive. It's turned black. The Renko has redrawn again to look more positive. And the three-line break also looks positive. Looking at some other indexes, here's the S&P to the equal weight index, where the equal weight continues to underperform. And here's the ratio. I haven't shown this chart in a few days. It shows that the big stocks are outperforming the smaller stocks in the S&P 500. Looking at our new take on Dow theory, we're still above this blue line here. If we continue to go up at about the 4200 level, that could end up being resistance. We're also showing a pretty nice breakout now with the NASDAQ. The Dow was able to recapture its 50-period moving average. The transports continue to underperform the Dow, and we've turned back to positive with the diamonds. The NASDAQ still looks like it's breaking out. We have some overhead resistance at R2. The NASDAQ also was able to get above this 38.2% retracement. We closed at 12,500. This level was at 12,427. But we're also seeing a negative divergence. Here's the S&P on top, and we're looking at a cumulative new highs minus the new lows for the NASDAQ, and they continue to drop off. The NASDAQ 100 also is hitting upper resistance, even though it had a good day. The Qs remain positive, and the NASDAQ 100 is coming back up to this 13,614 level. We're at 13,589 right now. The BPI for the NASDAQ 100 continues to show some strength. The FANG stocks are actually doing quite well and breaking out and showing a nice little breakout pattern. The small caps had a good day, but they really haven't gone anywhere. And then when we look at the Russell, the RSI has crossed above 50 and the MACD is starting to turn back more positive. The small caps, though, even though they're showing some improvement, continue to underperform the large caps. And the small caps have switched over to positive with the Elders Impulse system. Small cap growth versus value did show a little bit of a decline, but we're seeing overall strength. The mid caps also came right back up to their 50-period moving average. The Elder Impulse system has switched to positive. The mid caps also were down slightly when you take growth and compare it with value, but we're still showing overall strength. The micro caps are well above 100 right now. They had a good day. The home builders were pretty much chopping sideways with the S&P. We're breaking out a little bit with the home builders ETF. The ratio is holding up fairly well, and the relationship is still fairly strong between the two. Right now, we're seeing the home builders outperforming the S&P 500. Looking at some financial sector information, we were up over 2%, but we're still in an overall downtrend. The financials ticked up slightly, but still show a lot of weakness compared to the S&P. And the regional banking ETF did show some improvement, but is really underperforming the financial sector. Looking at our interest rates, we did come out a little bit of this rainbow to the upside. If we continue to go up, that may suggest that there will be a soft landing. Also looking at growth versus value, growth is really starting to outperform value on this chart. We're well above all the moving averages in the rainbow. Looking at bonds, we're seeing the longer-term correlation really start to weaken here. When we go back 50 periods, 10 periods, we're still showing that they're going in opposite directions. The spread is still pretty strong between the two. Bond yields were up and bond prices were down. Then long-term, the special K is still rejecting this red line right here and turning back lower. Then looking at our long-term analysis with a weekly chart of the S&P, the MACD continues to go up and we're above zero, suggesting that this breakout above the trend line is legitimate. Then an update of some of our possible positive scenario charts. I wanted to include a growth versus value longer-term chart than just the ratio charts that we look at. Since the beginning of February, that growth has really been outperforming value. Here's our ratio charts showing how the Qs outperformed the S&P. That's good for upward movement. Discretionary, even though it had an up day, is still not really breaking out. And large cap growth did outperform large cap value. Then our growth to value ratios, the large caps showed improvement, the mid caps improvement, and we actually turned down slightly with the small caps. The S&P continues to underperform the utilities, but we did show some improvement. And then when we look at the broad range of our 5-period moving average of the highs minus the lows for the Amex, NASDAQ, and NYSE, we still remain negative overall. And then our 50-period exponential moving average of the new highs, new lows still continues to fall. Our indicator, though, is showing some improvement. We have a reading of 10. Looking at the 2-year Treasury yield, we spiked up here and have been coming back down. Will that continue to give support to stocks? And then our staples, we also saw a decrease in the staples to S&P 500 ratio. Sometimes when that happens and this ratio falls, that gives really good support to the S&P. We're wondering if that can continue. So what's our outlook for Thursday? Earnings season still continues. The technicals are mixed to positive and we're near the top of the trading range that we've been in. We have weekly jobless claims and I'm starting to focus more on continuing claims as well. The Philadelphia Fed survey is coming out. Existing home sales will be coming out. And then the leading indicators. This is one that I've been really waiting to see because of a chart that I talked about a couple of days ago. We want to know if this indicator is starting to show some improvement because we're seeing a real disconnect between the S&P and what the leading indicators have been suggesting so far. Then the whole list of geopolitical events. Right now, it's more of a focus on the debt ceiling. Then here is a list of the different speeches that Fed officials are giving this week. There were none on Wednesday. Governor Jefferson will be speaking, and Vice Chair Barr will be testifying again before the U.S. Senate committee. And then the interesting one will also be on Friday when Jerome Powell and Ben Bernanke get down to have a little chat. Looking at the Stock Traders Almanac statistics for the week of expiration week, which is what we're in right now, we're up 45% of the time and we're down 55% of the time. And then the week after options expiration, we are a little bit better. We're up 64% of the time and down 36% of the time. Then for May 18th, which to me is a very important day since that was when Mount St. Helens erupted, if any of you remember that. But we're negative overall. With the Dow, S&P, and NASDAQ, they all are only giving us a 38.1% historical chance of being positive. And then we tend to be more positive than negative in May, but we tend to see more weakness in the latter part of May. We're on the 14th trading day of the month. The green line, it's pretty hard to see here, but it is declining. Then our scenarios. It's hard to go with the down one right now after such a solid up day unless you're really convinced that we're at the upper end of that trading range and we're going to hit the resistance and then start to go down from here. The technicals are mixed to positive, but we still have a lot of negative divergences. It's really hard to go with the up one as well because we're in that trading range and we're just not showing a lot of strength right now other than maybe one day here or one day there. So we still default to the sideways pattern of trending. Even though the ADX is strengthening, it's crossing above its moving average. It's still below 20, but the green line is advancing, so we default to the positive. So our warning signs, we still have a lot of negative divergences, and it's going to be this way for quite a while. The VIX is still showing a lot of complacency. The S&P new highs are showing weakness. They're not really breaking out, and even though they improved in Wednesday's session, we're not seeing a real turn up in our moving averages. The S&P is underperforming utilities. We're still in a risk-off posture, even though that did change a little bit in Wednesday's session. Small caps are still underperforming overall, but unless you look at the growth, then they're doing quite well. Mid caps have also generated a death cross when you look at just the index, but their growth stocks are also doing quite well. Is the NASDAQ or NASDAQ 100 getting exhausted? There's one chart that I meant to show in this video. It's by Tom DeMark, and it's showing a 913 exhaustion, and the NASDAQ is just about at that level right now. I'll try to find that chart and then include it in tomorrow's video. And then earnings season continues, but we're starting to get near the end of that. So looking at the positive signs, our longer-term positive seasonality and setups, those still apply for the whole year. Lower price levels may provide support. The NASDAQ is still breaking above resistance, and that's always positive. Small and mid-cap growth is showing strength. And then is the market bottoming by consolidating sideways? We're just throwing that out as a possible scenario. In one of the blog posts that Real Investment Advice came out, they brought this up, and I've been kind of mulling it around myself. Will a resolution of the debt ceiling crisis produce a short-term rally? Is the move that we saw on Wednesday, if it was in fact a response to the debt ceiling hope, that would be buy the rumor type of a thing. If they come out with an actual agreement, are they going to sell the news? Just something to keep in mind. So our conclusion, the S&P, it's mixed to positive. It's not trending, even though it's showing some improvement and showing a lot of negative divergences. In the short term, we've switched back to positive, but we're at the upper end of that trading range. Intermediate term, we're mixed to positive. Long term, we still remain positive. So thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.